I see a lot of traders online saying trading's very simple if you follow my method, or make consistent profit using this trading strategy. And it's usually by those flashy traders showing cars, watches, lifestyles. And to be honest with you, it's not as simple as these people make it seem to be. However, it's also not very hard, and it's very possible. There's no premise of finding these good setups or trading this method and you're going to be successful by tomorrow. There's a lot more that goes into that. And basically in this video, I'm going to go over the basics for what I look for before entering a trade to make sure the odds are in my favor. And I want to be on the right side of the market. I'm going to show you the charts along with some psychological points that I wrote up to kind of back it up. But before we get into it, I'm going to link my Instagram in the description below at Ameritrade. I definitely recommend following this. I post daily trading recaps on here along with very good trading tips and tricks that I guarantee you are not going to find anywhere else. The link is in the description below. But now let's get right into the video. I got inspiration and the idea to do this video. I was talking with my good friend over the weekend, and he works at a very big firm in the city, and one of the top traders at the firm does certain things I'm going to talk about in this, and I'll actually explain a good example of it. But it kind of gave me inspiration to do this because subconsciously, these are the things that I think about throughout the day, and even when I'm planning to trade something, to come up with quality setups and to make sure that the odds are in my favor. So the first thing is kind of like the macro view, and I must be familiar with the technicalities of the market. So every larger incident affecting price is going to be given due weight. What I mean by this is kind of the overall bigger picture. If we are day trading, the premise to this video, scalping, day trading, sometimes we get too focused on the smaller time frame picture, looking at so much of intraday fluctuations, that we forget about everything that's going on the macro view and kind of like the larger picture that will affect the smaller view. Now, what I mean by this and how I do this is, number one, I'm not sure if the guy on Wall Street does this, but this is what I do. I look at context. I would say context is one of the most important things to me because it's given me the relationship between buyers and sellers. And the way I look at it is the market's a storyteller, and we must get context clues of the story that the market's trying to tell us. It's never going to tell us the story directly, but it's going to leave us clues. And, think about your kindergarten teacher saying, use context clues to understand what this word means. It's the same thing with the market. So I kind of use the relationship between buyers and sellers to get a good idea of the context with the market. And as I'm recording this video, the past 2 days in the third week of April, had very large sell-off days. This is talking about the S&P 500, and even I could pull up NASDAQ. NASDAQ's the same thing. Overall, very bloody in the market the past 2 days on a Thursday and Friday of April 21st and 22nd, and the market was selling off very aggressively. Now, prior to this, this is where context comes into the picture, the market was very balanced. Now, the idea in balanced markets usually is to buy the lows, and sell the highs because the market is in balance. Buyers and sellers are agreeing on price, where every move up would get sold into and every dip down would get bought into. That's when the market's in balance. And then when we get an imbalanced market where it's basically moving out of balance, or one side, either buyers are showing aggression to the upside or sellers are showing aggression to the downside, that's an imbalanced market. Imbalance, not imbalance. That's when we're going to get continuation, and that's when we're going to get the large rallies or the large sell-offs to the downside, that the either sellers are outweighing the buyers or buyers are outweighing the sellers. In this case, to start the week, we had a strong uptrend, 3 days of dips getting bought, some rallies kept showing continuation, and supply zones not really being very reliable. Then the market on Thursday and Friday hit a very key supply zone. This is on the S&P at 45.03. And even on NASDAQ, I'll make this a little bigger, hit a very key supply zone at 14277.5. That every time we test it, see if I can pull this up here. Every time we test it, we fail at it. So, 3-4 times in the past, this zone has rejected and we've sold off from it every single time. So we have clear sellers now evident in the market. And as the market's moving lower, we had a day on Thursday where it was an all-day sell-off, where demand zones the day prior, even a few days prior, I could mark a whole bunch of demand zones. They got destroyed and didn't find signs of buyers. So when the context is weighing this heavy to the sell side, I use this context of being less inclined to playing the market to the long side, and I rather focus on shorting rallies to the upside that fail if we are talking about demand not being reliable and supply being extremely reliable with a very heavy market sell-off to the downside. Now you flip that to the upside. Act like this is a very strong uptrending market. We might have a supply zone in this area right here. The market opens up. We hit demand perfectly. We rally. We hit supply. Act like this is a pink box. And we automatically just slice through it. Show no signs of selling. Now we have a strong, clean uptrend in our picture. And maybe the next day we might look for some continuation. The next day we balanced. The day after that, we got that move up into that key supply zone and sold off. So the market's dynamic. It's constantly changing. And if we were to use the context from this day's action on Thursday, where there was very heavy selling, no aggressive buying, very aggressive selling, the following day, here's that Thursday, here's that Friday, same thing. Remember what I mentioned about all those demand zones not being reliable on Thursday? What makes you think they're going to be reliable with the similar or the same action that we saw the day prior? So that's market context. You could look at that as a weekly scale. You could look at that as a monthly scale. It really depends on the time frame you're looking at. I like to use a good reference of the past week, the current week, and overall, I could look at, go to a new drawing set here. You could look at a daily chart and kind of get a bigger picture of what's going on. When the market was strongly uptrending back in, May, June, all the way to the new year, dips would get bought up easily. I could draw 100 different demand zones, some in this area, some in this area, that dips would get bought up and supply would not be very reliable. But now the market's balancing out where rallies to the upside have been getting sold into and dips to the downside have been getting bought. And the philosophy that I use in the market is when there is a different reaction, we're going to get a different result. But when there's the same reaction, the odds are we're going to get the same result. So the day prior, like I just said, all day sell off. The following day, same thing, demand zones not being reliable. And you could use this to your advantage because you could come up with an intraday plan that uses failing to find buyers at demand to possibly play the market short if we could get selling confirmation. So that's kind of a lot on market context. If you guys want me to do a more in-depth video on all these points I'm going to mention, just let me know. I have no problem doing it. But really, how this guy on Wall Street does it, he's big into oil and other commodities. I can't get into too much details, but his edge is knowing related markets. And I think this is key even for us day traders, specifically the S&P, specifically NASDAQ, and even other major market leading names. I love trading options on names like, Apple, Microsoft, Tesla, Facebook. And I think this is key for us as well because we must look at different related markets. This guy has an edge in, if let's just say he wants to trade crude oil, he'll be looking at, let's just say, heating oil or gasoline. He'll look at the two spreads, he'll look at the net differences, and without even looking at the charts, he'll get a good direction of the market he's looking to trade just by looking at different related markets. So that's an edge in itself, and I think that's very important in getting a macro view of the setups that we are trying to trade. If I'm looking to play, I'll get into this a little more in detail, but if I'm looking to play Microsoft long, right, and I see maybe NASDAQ selling off aggressively, I might hold off on playing Microsoft long. Or if I'm looking to long, let's just say NASDAQ, right, after it hits supply, maybe we have demand in this area right here. Let's just say we had demand, that's a green box. I want to look at maybe, let's just say Microsoft, Amazon, Tesla, and I want to make sure if NASDAQ is bouncing off the zone, I want to see other equities also showing strength. I don't want to see weakness in the market because that's going to basically validate that this bounce off demand is going to be weaker and we are going to see continued selling to the downside if related markets or related instruments do not agree with our analysis. So I think looking at related markets is very key. there's a website called Slick Charts. I could actually pull it up here. Where you could see the weight of each company. Like I traded Boeing the other day, and Boeing is a major Dow component, not so much NASDAQ. And I was looking at the Dow future when I was trading Boeing as well. But you could go into companies and you could see the weights of each major market leading indice and which companies basically lead or make up the market. Look at it as like a bread basket and the stocks that are bread in the basket. That's a good little tip. And then different economic events, news, catalyst. I do this before the market opens up. I'm aware that maybe Powell might be speaking on Wednesday, or there might be earnings for Tesla tomorrow, and this thing has a nice setup, and I know the premiums on the options are going to be jacked up. So I think these are three major components to like the macro view that could affect my analysis intraday. And it's important to know the larger time frame picture when you, even if you are trading intraday. And now intraday is much more important because this is where execution. And execution is the hardest part for any trader, beginner, advanced. And basically how I trade and what I want to see is if I could read the market properly. Can I read the story properly? If I can't, I most likely will not trade it. Members in the Discord have asked me sometimes where there was a clean setup. Perfect setup. It worked out according to our pre-market plan. And sometimes I didn't take the trade because I didn't read it properly. So even though some things might work out, if I can't read it and understand the driving forces backing the move or backing the market, then sometimes I might miss a move because I can't properly read it or I can't properly see it. And if I can't do that, then I know the odds might not be in my favor, and I'm okay with sitting on my hands and waiting for a better setup. So it's really putting the pieces together. Intraday context now. Relationship between buyers and sellers factored in intraday. I used this example in one of my other videos that I just made, but let me pull up the S&P here. And remember that example I just showed you about? We hit supply. There were tons of demand zones in this area that we invalidated. Now the following day, how that would protect me is on a day like this where I saw demand zones not being reliable and supply zones being extremely reliable, where every single time we would move up, we would fail. I would use that context the next day, and that either A, might prevent me from getting into another trade at demand, because what this tells me now intraday is since yesterday we're in a severe downtrend, demand zones are not being reliable, what makes it seem that, yeah, we're at demand? What makes it valid that we might bounce out of this level? It's possible, it could work, we could rally 100 points out of it. But because of the action yesterday, I'd rather be a little defensive and let buyers really prove themselves to me for me to play on the same side and be a buyer in the market. So that's kind of the intraday context. Or B, so A will let me prevent me from taking a bad trade, or B, it might let me take a really high quality trade because I could recognize this and say, hey, we're not finding buyers in demand. Let me look for an area that I could find sellers active intraday. Let me take the market short, respect my risk, target the demand zone lower, and we hit every single demand zone lower, very similar action to the day prior. Now, how this also will help me is how is volume. Volume is very key. I got some videos on my channel about volume, and if I don't see volume, I probably will not take the trade. You could ask any trader that is an intraday trader and how important volume is to their analysis. It's everything. Volume shows interest, and if there is no interest in the market, the chances of continuation are very slim. Interest also makes sure you are trading on the right side of the market with the same participants that you want to drive the market in that direction you are looking to trade at. So volume is very key. If I see a lack of volume in my direction, I'm either getting out or I'm not taking the trade. Related instruments, exactly what I just mentioned before. Do they support my analysis? I must recognize inherent weakness or strength in the market. A good example of that was, let me pull up the Microsoft example here again. So Microsoft back on 419 bounced off this very, very key demand zone and had a very strong rally. Now, if I was trading Microsoft and I wanted to get long Microsoft, or if I'm even trading the S&P, right? I just recognize, okay, the S&P just hit demand. Microsoft is rallying. what looks good to me. Maybe I'm not an S&P trader, and maybe I trade in equities. Okay, I'm gonna get long Microsoft. I see the S&P is bouncing off demand. I see Nasdaq is bouncing off demand with it. I see other major market leading names rallying. Amazon started rallying to the upside that day. Apple started rallying to the upside. So we had very strong confluence with other major market leading equities, and that kind of supported my thesis. If I was trading SPY, or if I was trading the Qs, or even if I was trading Microsoft itself. So always look at the related markets. If you're trading Boeing, or if you're trading Lowe's, or any major Dow Jones stock, make sure you're looking at the Dow to support that analysis. If on Friday, April 22nd, the Nasdaq was aggressively selling off, right? Lower lows, lower highs, got below our bearish line at 13647, and let's just hypothetically speak here. Let's just say Tesla had demand, right? This is a good example. So Tesla was relatively strong because compared to the Nasdaq was selling off all day, while Tesla was holding strength, relatively strong, and we closed, not very red on the day. So let's just say Tesla had demand that formed intraday. Let's just call it in this area right here. Picture that being a green box. Tesla pulls back into this demand zone, and it looks like a start coming up, right? Yeah, you could take it long. Yeah, you can make money on this setup. But like I said earlier in the video, are the odds really in your favor? You could get a quick 30-point rally on this. No problem at all, right? But if I'm looking at NASDAQ and I see NASDAQ, at the same point, Tesla's in this demand zone and NASDAQ's in demand, but NASDAQ is failing to rally to the upside, and I'm looking to trade Tesla, more than likely, I'm not taking this Tesla trade because my underlying related market is not really agreeing with this analysis. However, if I am trading Tesla and this thing does start looking good off demand, and I see NASDAQ, let's just say, I don't know, let's go to a different day, and I see NASDAQ maybe bouncing off demand right here, and it starts moving up at the same time Tesla starts to move it up as well, then yeah, maybe I'll take Tesla because I know the odds are in my favor. The market is a probabilities game. I trade only when the odds are in my favor, when my edge is present. If it's not, I'll either A, trade smaller size to protect myself for a loss that I could have avoided, or B, which I recommend everyone to do, not trade until your setups trigger. So looking at related markets is a very key thing. Use that example with the guy on Wall Street that I said earlier. And finding a proper entry point is something that's slept on. I think entries are the most important thing. A good way to get better at entries or confirmation is to record your screen. Every day, record your screen. And then go back after the market closes, look at what you could have done, what you should have done, what you shouldn't have done, and what you did wrong to kind of correct and fix. And then once I get my entry, then I get my stop loss where my analysis will be incorrect. And where I'll be correct is my target. And then I put the trade on. And then the result is either going to be a win, I hit my target, or I hit my stop loss, my analysis is incorrect, and I focus on another setup. So this is kind of like the checklist of the things that I look for. It's a 19-minute video, and I tried to squeeze, I could make this a friggin', 3-hour long video if I wanted to. So, and then after review, if I lose on this trade, it's okay. I will have losing trades. Persistence will keep me at work during adverse periods. Self-belief, knowing I trust my plan and I trust my emotions to get me back on track. And self-control to avoid overtrading. A lot of traders do not have self-control. They force setups, they overtrade, and they just keep, stabbing themselves in the leg, destroying their account and depleting their money. And they don't believe in themselves because they don't have confidence. They don't have something that works for them. And you can't have persistence if you don't have self-belief. So I hope this video helped, kind of tying in emotions to what I look for intraday and macro picture. If it did, drop a like, comment if you have any questions. Definitely check out the links in the description below. I offer a in-depth and educational course that comes with access to the Discord and no extra charge. Definitely take advantage of the prices on the site. But I'm ending on that note. Peace out.